It's all just records being updated in different databases, coordinated across multiple institutions in the blink of an eye. The money wasn't sent. The record of who owns the money was changed. This system of digital ledgers and trust networks is incredibly efficient, but it also reveals a deeper truth. The movement of money is really the movement of information, and whoever controls the flow of that information has immense power. This brings us to an even more hidden layer of control, one that affects not just your individual transactions, but the entire economy. I'm talking about central banks, like the Federal Reserve in the United States. Now, a common misconception is that central banks directly control the money supply by printing massive amounts of cash. While they do manage the physical currency, their real power lies in something far more subtle and powerful: controlling the price of money itself. They do this by setting interest rates. The interest rate is essentially the cost of borrowing money. Think of it as a tap that can either encourage or discourage the flow of money throughout the entire financial system. And this is where the real steering of the economy happens. When a central bank wants to slow down the economy, perhaps to fight inflation, it raises interest rates. Suddenly, it becomes more expensive for you to get a mortgage, for a business to take out a loan to expand, or for you to borrow on your credit card. Money becomes tighter. People and businesses spend less, and the economy cools off. This is what we've seen happening recently around the world. On the other hand, if the economy is struggling and the central bank wants to stimulate growth, it lowers interest rates. Borrowing becomes cheaper. Mortgages are more affordable. Businesses are incentivized to invest and hire, and consumers are encouraged to spend. Money floods into the system, not because more was printed, but because the cost of accessing it went down. This creates a powerful incentive for economic activity.